All right, hey everybody, sound check. Can everybody hear me okay? Sounds like yes, 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 yes. Okay, awesome. All right, well, what I want to do is I want to talk about my favorite free indicator that really changed my trading life. Because prior to this, I would trade and I'd make a lot of money, and then I would lose it all. And I really didn't know why I was making money, and I didn't know why I was losing money. And obviously, that was frustrating. And so my thought was if I could identify the moments in time where I'm making money and then just keep focusing on that, that would make my life a lot easier. And, 17, 18 years ago, I stumbled across this kind of idea and turned it into a tool, and it changed my trading life. And so that's what I want to talk about tonight. So, my favorite setup. So, welcome. Let's dive right in. So, what we're going to cover is basically the ultimate guide to using the best free trading indicator out there, why this tool is a game changer, how it works and what it does, and then just how to set it up and how to use it. And on top of this, since I've been using this thing for like 18 years now, over time you really start to learn the nuances of it and the tips and tricks of really how to maximize it. And I want to share that with you guys as well. So this really came to a head when I made my first $1 million trade in 2014. Now, this is in January of 2014. Now, prior to this, my biggest trades were six figures, low six figures, in terms of making, that amount of money in one day. And once I kind of found this tool and I got into a rhythm and I was getting more consistent, but I didn't have any what I would just call mind-blowing trades. I mean, making $1 million in a day is kind of like that's a game changer. It makes you rethink what's possible. And it was a really fascinating moment, at least in my trading history. So what happened here was there was a squeeze. This is the squeeze. Obviously, we'll talk more about it. And, the move here, and this is way back when Tesla was like $150 stock, pre-split, if you can imagine that. And this move was, 25 some odd dollars in a very rapid amount of time. And as I saw that it was working, I kept adding to it and adding to it and adding to it because this tool told me that it was okay. And then I got out when the tool told me that it was no longer okay to be in. And by the time the dust settled, the trade ended up being a $1.5 million trade. So I made $1 million the first day, and then the next day it gapped up. I sold off the rest, and it was amazing. I mean, it was life changing in many ways because first of all, it changed my perspective on what was possible to make during a day of trading, but it also started me along the path of my belief, which is that trading is a way to make money. And then you owe it to yourself to take some of that money out of the markets and put it into tangible assets that'll appreciate in value, that you can utilize and that you can experience. And we'll talk a little bit about that too. This is a screenshot that I did of the trade. This was towards the end of the day. Again, it's so funny to see Tesla at $161, but that was a huge percentage move that day. Closed the day, up $1 million that day, held some of it overnight, and then it gapped up, and it was just amazing. And so what I did is I took money out of my account after that, because suddenly now I had this, account that went from it was high six figures to now, being 2.5 something million dollars. And which at the time was the most money I'd ever had in a trading account. And so I promptly took some of that out and put it as a down payment on this ranch. This is outside of Austin, Texas, and we still live here to this day. We've added to it over the years. And what's ironic is at the time that I did it, my friends all thought I was crazy. Since then, the land values have gone up 4x, and it's impossible to find land out here now. I would love to buy more, but there's just none available. So, it was a good investment long term. It's something that we get to use and get to utilize. It's been great having the kids growing up on it. But at the same time, it gives me a strong reason to trade. Like, what's your why when you trade? Otherwise, it just becomes a video game. And I think when you have a strong why, you actually take trading more seriously, which I think is important. Because it is tough. It is easy to treat this like a video game, and then it's just like you make money, you lose money, and the cycle goes over and over and over again. You really never understand why it's happening. So So what's happened is over time too, we've tweaked this. We've added some additional tools to this, and in 2014, that was a great year for Tesla. Then what happened is in 2020, a lot of things came together, and we made some improvements in the squeeze, and it was a really an amazing time. And so on May 29th, 2020. I posted this on Twitter. It said, all right, as we head into the weekend, we've got a daily squeeze, we've got a 4-hour squeeze, and these are time frames, by the way. So on the 60-minute chart, there was a squeeze, and on the 30-minute chart, there was a squeeze as well. And just looking at this, and I sent this out, I said, look, this is a lot of energy, and this is the whole point of this. Is that there's a lot of energy building up, and for a stock to move higher, it needs a lot of energy. It takes so much energy for a stock to move higher, and all that has to happen for a stock to fall is a lack of buying. Okay, a stock can fall on its own weight as it just starts taking out stop losses, but for it to move higher, there has to be a lot of energy expelled, and this whole tool here tells you when there's a buildup of that energy. And when there's this buildup of this energy, it means it's about to be released, and that's when you make the money. And so I saw this happening, and this is a lot of time frames coming together. I love daily charts, but when they convert together with, the 4-hour chart and the 2-hour chart and the hourly chart, it means there's energy building up on multiple time frames, and that becomes very, very powerful. And so what happened here on this one, now, again, this is pre-split, right? So this is when the stock, it hit $1,000, but this was before it split, I think it was whatever it was, 5 for 1. So you had this move where we went from about $820 up to $1,000 in a very short amount of time. So it was a $180 move. I had my options in place, and it turned into another $1 million trade on Tesla. So this particular one, and I'll talk about some of the strategies I do option-wise here, but I had a diagonal where you're buying calls that are a little further day out and then trying to offset that decay by selling calls against it. Now, ironically, had I not done that, I could have made more money, right? Because it went through the strike, but that's okay. And then bought some straight calls, so that's nice. You're just buying the straight calls, sold some puts and things like that too, and turned into a 7-figure trade in a short amount of time. Now, this started off this chain reaction in Tesla where I had $6 million trades in Tesla in 2020. And I ended up having $1 million trades in other stocks like Google, and in other markets like gold too. But Tesla is just it was my first $1 million trade, so it kind of has that special place in my heart. And I always say, look, you don't want to get married to a stock. Just because you have a good experience with a stock one time, it doesn't mean it's going to keep working for you. That being said, though, and I always like to say this, I trade the setup, not the stock. So I know the setup that I'm looking for, and I'm happy to look for that setup in a Home Depot or a McDonald's. But I'm always going to look at Tesla and see if that setup is there first. Why? Because it moves. When the stock goes, it'll go 20 points at a time. When McDonald's goes, it'll go 2 points at a time, right? That's fine. So the point is I'm not arbitrarily, is that a word? Arbitrarily trading Tesla like, oh, it's got to be, no, it's a specific setup, and it's the squeeze, right? And so that's what we want to look for. So these are, and I've had a lot of other trades with the squeeze. These are simply the ones that made over 7 figures. So in June 2020, $1 million trade. That was the second one. July 2020, $1 million trade. In August 2020, biggest trade ever, turned into almost a $4 million trade on Tesla. That was a crazy trade. We'll talk a little bit about that. I remember that too, because Thinkorswim actually went down for a couple days, and I had to manage that on my phone, which was crazy. In August, another $1 million trade in Tesla. In August, a few weeks later, another $1 million trade. In November, a $1 million trade. And then in April, my biggest trade ever was a $5 million trade in Google, straight up squeeze. And then in May, there was a $1 million trade in gold, and then there was another $1 million trade in bonds. And again, the point of all this is these are highlights. They're examples of bigger trades, but it was the same setup. Okay, it wasn't like, oh my God, I think Google's going to do something here, or Tesla's a great stock, let's buy some more. It was no, there's the specific setup, a specific things that came together that said, all right, there's a higher probability that this is going to make a big move now, like right now, instead of just trading sideways. Because look, if you buy like calls and the stock trades sideways, you're dead, okay? And 80% of the time, stocks are trading sideways. So the point is, we got to pinpoint that 20% of the time when there's an explosive move setting up. And we can't guess, like, that doesn't work. So this was the question that I had to answer for myself, is when I went back and I looked at my winning trades and said, okay, what's the commonality here? Why do some of these trades work out so great? And then other times I just get my head ripped off. What are the commonalities here? And as I discovered these commonalities, and it was 3 things, and when I combine these together, it's like, wow, this was amazing. It's kind of like, you're like Bollinger Bands and Keltner channels and momentum oscillators, and when these things do a specific thing, when they come together in a certain way, it's screaming loud and clear that there's a signal. It's screaming loud and clear that there's this buildup of energy. And when this energy is released, the move is going to be big. It could be up, it could be down. And we'll talk about, how do you figure out which way it's going to go. But the point is, this is the time to make a directional bet. This is not the time to sit on the sidelines. This is not the time to wonder what's going to happen. It's your probabilities of success have increased exponentially over normal day-to-day market movement. And that's when you place your bets. In fact, the secret to trading is to recognize when you don't have an edge. Remember, 80% of the time stocks are going back and forth, you don't have an edge. It's better to do nothing during that time and actually sit on cash. A lot of times people forget there's 3 positions that you can have. You can be long, you can be short, or you can be in cash. And 80% of the time, cash is where it's at. Okay, because you don't have an edge. And the way you make money trading is you identify an edge. So the squeeze here, it's called the TTM squeeze. TTM stands for a company called Trade the Markets. That's that was a company I founded, 20 years ago. And then eventually we changed that name to Simpler Trading. But people ask, what does TTM stand for? That happened to be the name of the company at the time. This is a tool that's available for free, and I'll show you, where you can get it and stuff like that too. So even though this thing is 20 years old, I use it every day. I cannot look at a chart without it. In fact, to me, if I'm looking at a chart without this tool, I feel like I'm trading blind. I'm like, why would I ever, want to do that? Why would I want to risk my hard-earned capital on a situation where I don't feel like I have an edge? And if there's no squeeze on the chart, I do not have an edge, okay? Now, what's also happened over the last couple of years is I've been using this thing for over 20 years. We ended up doing some tweaks to it and making it even better. All right, and we'll get to that a little bit later. First, I just want to kind of show you the basics of how this works and then show you some of the improvements that we made. So the TTM squeeze, it is a free indicator that's out there. It's available. And Thinkorswim, Tastyworks, etc. And I'll show you where you can find it. But again, free tool, and these red dots are basically saying, hey, this is one of those 20% moments in time where instead of this stock just kind of going back and forth, it's up, it's down, it's up, it's down, it's trading in a range, which can drive you nuts if you're buying a call, right? Because you're up one day, you're down the next, you're losing premium decay, right? And there's strategies you can do here, of course, like iron condors. But iron condors, which I like, they're for income. They're for paying the bills. You're not going to make $1 million iron condor trade, okay? If you're going to make $1 million trade, it's because you caught a move. You bought calls at 6 and you sold them at 50, right? That's how you make money. That's how you create wealth trading. Nothing wrong with income, and I'm always looking for income. And as I'm sitting there and I'm trading for income, I'm like, okay, where's the next big move coming from? And that's what I'm looking at here. So this is Roblox. We're trading sideways, and then boom, we have a focused move of about 15 points. And you can see here, instead of range bound, this is something where you can make money if you've got a directional trade on, and we've got a signal telling us, hey, this is the time to make that bet. Okay, so anyway, so that's all that. So why listen to me? Who am I to be talking about the squeeze? Am I some guy that just started a TikTok financial? I can't even say it right. That I just started a TikTok financial channel last week. While I was living the nomad life and YOLOing my life savings. No. So my background is I'm from a military family, so I grew up in a household that had a lot of discipline. This was my great grandfather who was in World War One. That's me in that lovely 1970s sofa. This is my grandfather. He was in World War II. Amazing story with him. He was wounded in Italy and left for dead. And they came back a week later. He was still alive. He recovered in an Italian hospital for a year. And if he wouldn't have made it back home, my mom wouldn't have been born. And of course, I wouldn't have been born. So a lot of courage. And that's my father. He was in Vietnam. I never joined the military. I think I don't know why. I'm actually a fan of discipline, and I studied military history, but I don't know, just military, as I looked at it, I respected it and just thought, you know what, I'm trading as kind of my life path. So in 2005, I wrote a book called Mastering the Trade with McGraw-Hill. At that point, I'd been trading pretty actively. My first trade was in high school. So that was back in 1987. I didn't know what I was doing. My father was a stockbroker. My stepfather, he was a stockbroker, and he kind of started showing me the ropes with options, and I took it from there. In 2005, I wrote a book called Mastering the Trade, and then since then it's had a second edition and a third edition. The third edition, of course, is the most recent. And so that's been out there for a while. And there was a period of time where I was a sought after speaker, and I did the speaker tour. This was I don't remember if this was in Beijing or Shenzhen. This was a great crowd. This was in Prague. When I was on stage, I jokingly said I could use a beer, and like 10 people ran out and brought me a beer, which was amazing. This was in China, signing books. I've done CNBC, all that kind of stuff. And that's great, and that was a good experience. But and then through this whole process of trading, I've had some amazing opportunities. For a while, I was doing, and I still do some, crude oil analysis for Richard Branson's company. That's down there at Necker Island. And I've also done some work with Virgin Unite and on all that kind of stuff. So that was really cool. Branson was always a hero of mine, so it was awesome being able to turn my trading skill into a way just to kind of help him hedge oil, for his airlines. But these days I don't do any speaking anymore. I have kids, and I would rather watch my kids grow up than fly around the world doing talks and missing out on that. So that's super important to me. So I don't do the speaker circuit anymore. And at the end of the day, I want to trade. So if I'm flying around doing talks, it's actually kind of hard to trade. So this is my general setup. Obviously, multiple monitors make a lot of sense. Typically, I'll look at say monthly, weekly, and daily stocks on one set of screens, more intraday stuff, and then of course, email, chat, all that kind of stuff. I do like standing desks. I spend part of the day standing, part of the day sitting. I think it's important to move around. And I think it's good to have a good, clean office environment. I don't know if crystals work, but I've got them in my office. Maybe they help, maybe they don't. The crystals won't work without a good setup, though. So just FYI. Okay, so let's look at a few more Tesla opportunities. So amazing squeeze here. So this is so powerful. Now, a lot of times when you get a stock like Tesla and it's going crazy, you're not going to get a squeeze on a daily chart. It could be months before you get another squeeze on a daily chart. So there are times when I got to drill down to like an intraday chart, in this case, 30 minutes. This is the most powerful setup you're ever going to see when a stock has a huge run and then just starts to trade sideways, okay? Meaning it doesn't retrace, right? It's not doing a 50% retracement or anything like that. The momentum's coming down, and then you start to see the dots, okay? What do the dots mean? The dots mean there's a squeeze coming. It's a squeeze of volatility. The energy is building up, and then it's got to release that energy, okay? So when I see something like this, it's like, man, it's time to put on a big trade, because not only are the odds of this going higher, like in this case, 85%, but significantly higher. Not like, oh my gosh, look at that cute little $10 rally. Like 10% rally, 5 to 10% rally. And if an underlying stock is moving 5%, your options are doubling, tripling, quadrupling on that move. That's why options are so amazing. So in this particular case, this was a nice, almost $2.5 million trade. So on this particular, well, to start, this is actually not the finish of this. So on this, I bought 1,000 shares of stock. So I like to buy the stock because I'll buy the stock at the same time. Sometimes I buy the options, so I can get a sense of, okay, if the stock was at $1,644 and now it's at $1,800, what did the options do? So when I bought the stock at $1,644.50, notice that the call options I bought were out of the money. Okay. Most of the time, I think buying out of the money options is actually a bad idea. In fact, you'll always hear me saying, hey, look, buy in the money Delta 70 options 30 days out. Okay. What's the exception to that? The exception to that is if you have a squeeze. If you have a squeeze on a stock that tends to move like this, you can go out of the money, do it as a spread. Okay, that way, it's a $100 wide spread. I got it for $17 basically, right? And in this case here, you can see it's at $62. So I've got a huge amount of money in that. But, so the question is when do you take it off? So I continued to hold this trade. So why would I continue to hold this trade? Because the setup here, so now here's the daily squeeze. It had just fired, okay? It had just fired, so it had more room to go, and I wasn't necessarily in a huge hurry to get out of it. Now, I mentioned earlier that Thinkorswim went down. Nothing against Thinkorswim. I love that platform, but, it did go down. And I had to manage it from my iPhone. So here's my 1,000 shares still. Here's my call options. And at this point, the position is up $3.7 million. So, the stock continued to go up. And you'll notice here, so now if I was, a complete genius here, I would have only bought the calls and I would have sold calls against it. You can see here that I'm down almost $5 million on my short calls, but of course I'm up 8.4 million on my long calls, and of course the difference between that is my profit. Of course, plus the stock. So you might ask, like, well, why didn't you just buy the calls? Well, look, Tesla had a bigger move than even I thought was going to happen. So, typically it's like you measure out the move, and the short calls are going to help offset the long calls. And long story short, though, that's a great problem to have. I never cry when something goes all the way through my debit spread. That's fantastic. Plus, and the thing that a lot of traders will never tell you is that it is hard to hold on to winning trades. And if you do it as a spread, it just makes it a lot easier. Okay. If you're holding on to long calls and, oh God, seeing that those gyrations up and down can drive you nuts, and can create enough anxiety to the point where you're like, get me out of this trade. And it causes traders to sell too soon. Whereas the spread smooths it out. And even though I left money on the table by doing a spread, to be frank, I wouldn't have held it on. I wouldn't have held on as long as I did had I just had the long calls. So in my experience, in this situation, I'm completely happy with what I did. Okay, so what's the struggle here? Because trading is not always easy. Do I have trades that don't work? Of course. But the idea is that the trades that don't work, you're losing a lot less money than you're making on the trades that do work. So trading isn't always easy. And a question I always like to ask everybody, like, who here, you can raise your hand, who here has been struggling in growing their trading account consistently? Okay, yeah, everybody's going to have a winning trade, right? Everybody's going to have a good day. But the idea is over time, are you creating an equity curve that in general is going from the lower left of your screen to the upper right? Okay, yeah, you're going to have some little drawdowns and stuff like that. But if this is January 1st and this is December 31st, are you generally higher, okay, than there? That's the whole point of trading. Nothing else matters. It doesn't matter about the news. The only matters is the size and shape of your equity curve. And once you realize that, you start trading in a different way. Okay. A lot of traders I know, they find a setup they like, they trade one stock. They don't care about the hot meme stock of the day. They don't care about the news. They've got their setup and they want to just make an equity curve that goes, that does exactly what's happening there. So it can be tough though, right? Because it's easy to get caught up in the news. We got trade wars, we got a pandemic, There's all kinds of things happening in the news, and the news thrives on this. Okay, they've called the whole pandemic and COVID. The media loves that because everybody's glued to the screen, wondering what's going to happen next. It's like, oh, for the media, that's the best thing ever, and it's easy to get sucked into that. But as traders, we want to stay neutral. We want to stay focused on the setups that are going to do what? They're going to create an equity curve that goes from here to here. That's it. Okay, we don't want to get too caught up in the headlines or anything like that. So the problem is that if you're not aware of that, okay, and this happens to all of us. I call it going into unconscious mode. It's when our unconscious takes over. We get scared, we get nervous, we get angry, and in that situation, our unconscious takes over, and the market then starts to take advantage of us. Okay, what do I mean by that? So this is what I call unconscious trading. In unconscious mode, and a lot of people are doing this, by the way. This is why that if you're aware of this, you can take the opposite side of this, which is what the squeeze does, and make a lot of money. So people will see something going up, maybe they see it in the news, they buy it, and they get excited, right? They're chasing it, and they have euphoria. And then as it starts to go against them, they'll have some anxiety. Okay, gosh, as soon as it gets back up to the here, I'll get out, right? And then it falls to where they got in, and it's kind of denial, right? Then it goes below where they got in. Now they're starting to get scared, but they're not doing anything. They're frozen, right? And then depression. And then panic, and then finally capitulation, meaning they can't take the pain anymore, and so they get out. We've all done this. I've done this. And if I forget my rules, I'll do it again. So that's why it's important to have a checklist. It's important to have a setup, because if you're following that, this won't happen. And then the cycle starts over again. So one way to think of this is that your highest probability of success is to get in when other people are getting stopped out. Okay, so if you've ever gotten stopped out on something and then it takes off, if that's ever happened to you, that's what I'm talking about. That stop out, it was somebody else's perfect entry. Okay, so a lot of times when we're looking at a squeeze will form down here, building up energy for the next move. That's when you want to get in, not here towards the end of the move, right? That's where you want to be taking profits. So if you've ever caught yourself on the wrong side of that cycle, I think you're going to really like this tool and how it works. So the biggest barrier to enjoying solid gains with options is, bottom line, timing. When you get the time and direction right, you can do beautiful things with leverage. So the question to ask is, what if you can see when the bigger moves are coming? Remember, 80% of the time, the markets are kind of just random chopping back and forth, even in a strong uptrend, right? They're just kind of like, we're up, we're down, we're up, we're down. But if you're going to make money in options, you need like I call it the, 8 to 10 bar move, okay? It's not a choppy, it's boom, 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 boom. Okay, that's where you make your money in options. There's a couple of reasons for that. The short version is it's because of how options are priced. If you guys have ever heard of Black-Scholes, options price in what's called an expected move. And what happens if it makes, if it just kind of going back and forth and it does an expected move, what can happen is that you get the stock, you buy an option, and the stock does move up, but it moves up within the expected range of where it was already priced. So if you've ever bought a stock and it went up, but your option lost money, that's just what happened to you. Meaning that, yeah, you were right, the stock went up, but it didn't go up fast enough to take over the premium decay in the option. Okay, that's the whole point of the squeeze, is that it's identifying moments in time where the odds of an explosive move up are a lot higher. And that's where you make your money long options, because otherwise, you're chopping back and forth, and it's got to take that theta decay will kill you, especially if you're buying an out-of-the-money option. The squeeze is telling you, hey, the odds here of a greater than expected move, a move that's above and beyond what the market makers priced in, is about to happen. And the market makers don't know this. If they did, they would price the options higher. They would make it harder to make money in these situations, but they don't take, this is not something that's calculated in Black-Scholes. This is why it's so powerful. All right, so what if you could see this happening? Okay, so my favorite trade then, of course, is going to be what's called the squeeze. And for everything we just talked about, we're trying to find where are those greater than expected moves that are basically going to run over the market makers, okay? That 80% of the time the market's chopping around, we're not interested in that. Okay, we want to identify the 20% of the time when we're going to have that greater than expected move, and we don't want to guess at it. We want to know with a reasonable certainty that it's going to happen. Okay, that's what's called edge. And I've learned to basically, if there's not a squeeze, just stay away. I can't emphasize enough how much staying out of the market if you don't have an edge is in it of itself an edge. Because what happens is a lot of times people, they get bored and they do a trade and they lose some money, and they do a trade and they lose some money, and they do a trade and they lose some money, and then they start to get frustrated, right? And they start to get frustrated and they get distracted, and then they miss the next setup because they're so busy digging themselves out of the hole they created because they were chasing the news or trading out of boredom. They missed the next real setup. There's a huge, huge power in being calm and being able to stay out of the action until the setup you're looking for is there. That's what a professional trader does. That's what somebody does when they want to take control of their financial future and not screw around and piddle away their chips in the market on inferior setups. They're designed to take away your money. The market is designed to take away your money. And if you're not aware of that, welcome to trading. However, if you have the patience to wait for an edge, and this is what my trading mentor told me, she beat it into me. John, most traders are not born with the patience gene. And if you do not develop the patience gene, you will not make it. Okay? So if you have a setup like this is defined. It's going to force you to be patient. It's going to save you from yourself. That's how you make money doing this. That's how you make superior returns. All right, so here's a Google chart. So how does this work? Why is it important? So if you're looking at Google here, you'll notice here that, okay, look, there's a good move here, right? And, there's a good move here, and there's some good moves. But if a lot of times, it's just kind of trading back and forth. If you buy calls here, you're dead. If you buy calls here, you're dead, anywhere in here. So unless you're able to time like a 5-bar move. And so I was telling you earlier how, when I first started, I was always an aggressive trader, and to an extent I still am, although I've mellowed out. I would go back and say, like, gosh, what was happening to this stock? What were the commonalities of this big move? Okay. Why was I able to make a lot of money here? What was happening? Versus, what was happening over here when I lost my butt. So if you look at this, look, this is a nice uptrend, right? You should be able to make money in an uptrend. But a lot of times, you remember that emotional cycle we looked at? Well, a lot of times people get excited, they buy here, and then they get stopped out here, right? And then they get excited and they buy here. And, they get, whatever, and they get frustrated, okay? And maybe they get stopped out and then it pops up. And the cycle repeats itself even in an uptrend, right? So how do we do this? Okay, this is where the squeeze comes in handy. So the squeeze is basically saying, look, the red dots, and even right here, the red dots are saying, look, there's a higher probability that we're going to have a focused, concentrated move in the very near future, like right now, than at any other time. So if you look at this and say, okay, well, and what I do when there's red dots, I'm fine starting to kind of build up a position. It's not a secret which way the market's going to go. If it's in an uptrend and there's a squeeze, the odds are incredibly high that trend is going to continue. Okay, the squeeze is not a reversal indicator. It's a trend continuation indicator. So here I can start buying calls in anticipation that it's going to trigger to the long side. Boom, right? And that's different than buying calls like, okay, here, I'm going to buy calls here. Yeah, that was a decent move, but a move like that, where you're going to make a little bit of money, is a lot different than a move like this. This was like a $150 move. You're kidding me? You got options? You just made a ton of cash. Okay, and here's another one. This one was hard to hold on to. I held on to this one for 3.5 weeks, and I kept adding to it and adding to it and adding to it. And I was down a lot. I was losing money on this trade because I got in too early, frankly. But I had so much confidence that when the energy here was released, it was going to be the upside. I didn't sweat it too much, and I kept adding to it and adding to it. This turned into my biggest trade ever. This was a $5 million trade. We'll talk more about that later, but that's how confident I was in the setup. Okay. Now, I didn't trade any of this. There was no squeeze. Why? After I traded Google like that, everybody in the room is asking like, oh my God, when's our next Google trade? I'm like, when there's a setup, right? And there's no setup, no trade. So that's so key. It's easy to get married to the idea of one stock because, we're going to have high dopamine associated with that movement. Like we're going to think back of Google very fondly after making that much money, but then we make the mistake of imprinting that and saying, oh, okay, what's the next? I'm going to buy Google again. No. It's the setup. So if there's not a setup, I'm not trading Google, right? I'm going to go trade McDonald's or, whoever has a setup. That's so important. It's the setup, not the stock. So the squeeze is the most versatile trading tool I've ever come across in my years of trading. If I like to trade options because I love the leverage, but you can trade the underlying stock, just buy the stock. You can trade futures, currencies. It works on crypto too. A squeeze in Bitcoin or Ethereum, awesome. Those are great. So not only does it pinpoint moments in time where you can look forward to a greater than expected move on any asset class, okay, Bitcoin, bonds, Tesla, it's all the same. Okay, it's an expansion of volatility and a compression of volatility, right? That's it. But if you've already got a setup that's working for you, the squeeze also is really, really good at complementing other systems as well. So in some, it's my favorite. I personally cannot look at a chart without the squeeze. If I do, I feel like I'm trading naked, and that's not in a good way. Okay, so here's the squeeze on Google. This is a one-day chart. And this is a free tool on Thinkorswim, okay? And basically, when you see the red dots, it just means that the energy has compressed to the point where it cannot compress anymore, okay? By the time you see a squeeze, it has already been choppy. But now it's compressed to so much that it's got to release that energy. Okay, that's what we're looking for. And then it releases it. And then it starts to build up energy again, right? Wow. And then it releases it again. So, even though I like trading Google, I'm only going to trade it when the setup is there. And it's so important. So it's great on the indexes as well. So again, same idea. Here's a squeeze, right? Daily chart. And by the way, you can use this on any time frame. Basically when you're in a squeeze, the signal tends to last 8 to 10 bars, okay? So if you're doing a daily chart, you're going to be in it for 8 to 10 days. If you're doing an hourly chart, 8 to 10 hours. If you're doing a 1-minute chart, 8 to 10 minutes. Personally, I don't do any squeezes on any charts less than 30 minutes. It's frankly not worth the time. It's a lot of work to find a squeeze and wait and set it up. And so, a 1-minute squeeze, maybe the S&Ps move 3 points. It's not bad. I'm not knocking it, but I personally would rather wait for a daily squeeze. Can I catch 50 points? Can I catch 100 points, right? So but also too, it depends on everybody's lifestyle is different. I got kids. I got animals to feed. I've got a wife that wants me to talk to her. So I can't, back in my 20s, I would sit there and scalp futures and I would do that all the time. It was great. I can't do that anymore. I can, but I don't want to. I would rather do something like this. But the point is you can adapt it to your own lifestyle, whatever, some people don't like to hold trades overnight. It causes them anxiety. So yeah, maybe you want to do 30-minute charts. I personally cannot sleep well unless I do have positions on. Like, I want to look forward to something in the morning. So that's what we got. But the idea with this is that the red dots are saying, hey, it's building up. And then when you see that first green dot after the red dots, that means the signal is live. Okay, I call it firing. Okay, this just fired long. And at the moment in time that it fires long, if the histogram is blue, i.e. above 0, basically you're going to look for 8 to 10 bars of upside movement. And if at that moment in time, okay, it was red, you're going to look for 8 to 10 bars of downside movement. So that's what we're looking at there. Okay, so the other tools that I use in conjunction with this that I like quite a bit are exponential moving averages. I like the 8, 21, 34, 55, and 89. They're just Fibonacci sequencing numbers. And is it really important that you use those? It's actually not. If you want to use the 10, 20, 50, and 100 simple, that's another combination that people use. I use the exponential. That's just what I was trained on. Exponentials react a little bit more quickly to what's happening recently. And that's just what I grew up on, so that's what I use. But it's okay to use, the main point is you got a series of moving averages, right? And so what I'm looking for here is, what are the moving averages doing? The best trades, in my opinion, are when the moving averages are called what I call stacked positive, which what I mean by that is that the 8-period moving average is on top of the 21, which is on top of the 34, which is on top of the 55, which is on top of the 89. That is an indisputable uptrend in this case. And of course, it's the opposite for a downtrend, right? You can short as well. I love shorting, but I'm not going to short an uptrend because I don't, you can also stick a fork in your eye, and that's not necessarily the best use of your time. So if it's a downtrend, then I'll look at just the opposite and I'll short it, but I'm not going to short an uptrend. Like sometimes people ask well, it got up here. Why didn't you short it? Well, why would I waste my time with that? Because, look, you could argue, well, it's right here. It's too high. Why don't you short it? Because I don't want to get run over. Why get run over? So this is the cleanest. When you're starting out, this is the cleanest and easiest way to go. And then if there's a squeeze, buying pullbacks to the 21-period moving average, boom. Now, sometimes they're sloppy. Okay, here the moving averages are sloppy. And that can happen, but I'm fine with that as long as the 8-period moving average crosses back up above the 21. You can't really see it here, but the idea is that, hey, the 8 dipped down, and now it's back up on top. We have a squeeze. We can see that the trend is higher. If you're not sure if the trend is higher or not, you just look at the next chart up, okay? So like a weekly chart. And if on a weekly chart, all the moving averages are stacked positive, but the daily chart is sloppy, guess what? The weekly chart is saying we're in an uptrend. The daily chart is most likely going to resume the same direction as the weekly chart. So again, the easiest trade is like that when everything is stacked positive. But if they're muddled like that, the main thing I'm looking for is that the 8-period moving average is crossing above the 21. And again, in both of those instances, if there's no squeeze, I don't care. I don't care what the moving averages are doing here because there's no squeeze. So first squeeze. And then from there, I'm looking at the moving average to say, well, gosh, if there's a squeeze and the moving averages are stacked positive, the odds are like 90% that when the squeeze releases energy, it's going to be to the upside, right? That's why I'm looking at that. Okay. All right. So we just talked about that, but same idea, just another example. So, you got the squeeze, moving averages are stacked positive, and buy the pullback. Pullback to the 21 in that case is perfect. If it's a little sloppy, see here, this is the 8, it's below the 21, below. Once it crosses above and there's a squeeze, that's actually a great long signal as well, okay? Okay, so when should we get in? And that's, what's the plan? So first of all, there's got to be a squeeze, right? There's no squeeze, no trade. And in this case, this is based on a long trade, and it would be about, of course, the opposite if it was a bearish trade, meaning that there was a downtrend. So first there's a squeeze. The 8-period moving average is on top of the 21, which is on top of the 34, which is on top of the 55, which is on top of the 89. I mean, it's a no-brainer uptrend. Guess what? There's a squeeze, and in that situation, the odds are 90% that the market is going to, whatever you're looking at, is going to continue to move higher. Okay, that's the ideal situation. And then price pulls back to the 21-period moving average. Okay, that's my favorite entry. So the point here is that if there's red dots and it hasn't fired yet, but the moving averages are stacked positive and price is pulling back to the 21, I'm in. Okay, I'm anticipating that when it does release energy, it'll be to the upside. All right, now if you want to be safer, you can wait until the squeeze actually fires, which means that you saw that green dot. Okay, but I like to get a little early. I'm fine sitting through the wiggles because the confidence I have in this tool is that high. All right. So when the green dot appears, that's awesome. That means you're off and running. And then, well, here, let's just look at a chart. We can look at a lot of words, but charts help a lot. So this is kind of what I call the sloppy mix. As long as the 8 crosses back above the 21 and there's a squeeze, and the weekly chart, is in an uptrend, boom. Again, that's not the cleanest entry, but that can happen a lot, especially on some of the stocks that have been consolidating for a while. The cleanest way to do it is this. And if you're just new to this, wait for the clean ones. You get a squeeze. Obviously here, the moving averages are stacked positive. You got the 8 on top of the 21. Here's the red dots. My gosh, let's buy that pullback to the 21 and then hold on for the ride. That's what I mean by being patient. If you can be patient for those setups, you don't have to do a lot, right? You could do 1 or 2 trades like that a month, and you're going to be doing better than any other money manager out there. By the way, if you've got as retail traders, we're not managing $1 billion fund, right? We can get way outside. We're going to completely cream money managers with way outside returns because we're trading accounts where we have liquidity. I'm trading a 7-figure account, but that's way more liquidity available than $1 billion, right? If you got $1 billion, how many options are you going to buy on Peloton, right? 0. You can't buy, and if you can't buy enough to make a dent. If you're going to go out there and try to buy 20,000 call options, good luck. That there's no liquidity there for that. So that's the advantage, the edge we have as traders, as retail traders. Okay, so the main point of the squeeze is it's telling us that the stock is about to have a bigger than normal move, right? We've already talked about that. We got that compression and volatility. Most people who lose money trading options simply are unaware of this, okay? If you're trading options on a stock that's doing normal movement, that is already priced into the option. That's why you buy an option and the stock kind of moves up a little bit and you still lose money. It's because that game is rigged, right? You got to know when it's going to have a greater than expected move, which only happens 20% of the time, and the squeeze pinpoints that. Otherwise, you are trading a losing game. Like, you're not going to make any money doing this. So you got to understand how the markets work. Okay, so again, a couple more examples. Here's Microsoft. You got the squeeze. Moving averages are stacked. Buy the pullbacks. Again, I'll buy early and just hold on for the ride. And then, boom, we're off and running. Fizz, same idea. Again, we're not chasing it. Now, there was a squeeze here, right? But, the squeeze is over here. When the squeeze is over, and this is another huge benefit of this, is that if you see something, you're like, oh my God, I got to get some of that. And you're looking at it, thinking it's going to go higher, and you see that the squeeze is fired and has lost momentum, the trade is over. You actually should be taking profits. So if you don't have a position, you shouldn't be doing anything. That just means you missed it. I miss moves all the time. Okay, don't succumb to FOMO, which is the fear of missing out. Instead, do JOMO, which is the joy of missing out. Whoever buys right here, all they're going to do is fail. Okay, they're buying at the end of a signal. JOMO is the joy of missing out, meaning that you recognized that this was the end of an opportunity, not the start of a new one, and you did not get suckered into that. Okay, so is this complicated? So here's one of my students. He's 10, all right, my youngest son. He likes to make money trading because he likes to buy Robux, for the Roblox game. And so when he needs a couple $100, I give him 10% of the proceeds. It's fascinating because he comes in and because he's so focused on one thing, his win rate's very high because he's like, oh, I made my $200, I'm out, and that's it. So he's looking at these greater than expected moves to make a tiny amount of money. Like, he doesn't even care that it might go up for 4 more days. He's like, I'm out. It's kind of fascinating watching it. I've actually learned a lot from this, kind of observing his mindset as well on this. Okay, so where do you find this for free? In Thinkorswim, you're just going to go to Add Study. Okay, there's Studies, Add Study, and then you'll go down here to John Carter's Studies, and then TTM Squeeze. And there's not, it took us 2 years to get this onto the platform. And we did this like 10 years ago. And this is, they vet it. They're going to look at what you do. So it's a good, it's a good vote of approval when you get on there, because they don't take that lightly. And that's on Thinkorswim. So you can add that for free, which is great. It's also on Tastyworks and on TradingView and on TradeStation. Now, the irony of all this is that the TTM squeeze is our absolutely most searched tool on Google, and we don't have any tutorials really on it. Like, there's all these great other guys out there who do videos on the TTM squeeze. 200,000 views. They have way more views than we do, and which is I think is great. I love it. So a lot of people have recognized and they've adapted this tool, and they're doing tutorials on it as well. So I love it. I think that's fantastic. Okay, so long story short, this is a great tool, and at some point, I asked myself, is there a way to kind of improve this? Because while I like the big trades, they don't happen very much. A lot of things have to come together. You got to get that squeeze, you got to get the moving averages. And so a lot of times I'm like, look, if I can just crank out 2.5% a week, I'll sell some put credit spreads while I'm waiting for the next big trade to set up. That's great. So I wanted to look and say, is there a way that am I missing out? Am I missing out on trades here? And that's one of the things I wanted to look at. And so if we look at first of all, this is my trading for 2020. So in 2020, I had 3 accounts. I started off with $10,000 in one account, $260,000 in another account, and then almost $1.4 million. The ending balance, $54,000 here, $1.7 million, and then $17 million. So, of course, this is the account where I took the $6 million Tesla trades, and over the course of the year ended up being a 1,200% return, right? Fan is, pretty awesome. That's the kind of stuff that I like. Here's some screenshots of my portfolio. So December 31st, 2020, P&L year to date, 16.5 million. Of course, I wire money out still, buy more land, things like that, crypto. And then for Tasty, 1.4 million in profits. So that was 2020. And then 2021 also has been a fantastic year. And you can see here the results, the starting balance, the ending balance, and the percent, and just fantastic trading. So I love continuing to be patient for these setups and using the squeeze. So, and you can see here the P&Ls and all that kind of fun stuff, which is great. Okay, so I love the squeeze, obviously, and then the question that just kind of came up, just like 20 years ago, when I was asking myself, okay, I'm making money, but not all the time. What are the commonalities of the times that I made a lot of money? And that's where the squeeze came from. What happened after that is, okay, I can see here's a squeeze and there was a nice move, and here's a squeeze and there was a nice move, right? But why wasn't there a squeeze here? Why wasn't there a squeeze here? And so I thought, what? Let's play around with the settings. Maybe there's something I'm missing here. Maybe there's, while I love the squeeze, do I have the parameters set so tight that, it limits the opportunities, even though the opportunities that present themselves are amazing? And so that kind of led me down a rabbit hole. And when I looked at this stuff, it's kind of like, well, here's an uptrend. Here's all these moves, all these moves that were happening, but they weren't being caught by the squeeze, right? So here's this great down move. Like I said, it doesn't, whether the market's going up or down, it doesn't matter. Why was there no squeeze? Okay. Now, there was a squeeze here, but I don't count a 1-dot squeeze. And the reason I don't count a 1-dot squeeze, I'm not going to see that. It's too fast. So typically, I like to see at least 5 dots because, that gives it time to build up and stuff like that. And so that was when I started noticing, it's like, there's got to be some settings on the squeeze that would actually catch those moves and get us all excited about it. So that was, okay, so what are the settings? And then, not only are there settings that I'm missing, but are there settings that could even give a heads up? Like, I talked about that 1-dot or 2-dot red squeeze. Is there a setting on it that'd say, hey, heads up, this thing's about to turn into a 1-dot or 2-dot squeeze, and give me a heads up? So what we did is we played around, and so here's the normal squeeze that we've been talking about, right? There and there. So I loosened up the settings a little bit, and you can see that, of course, these are the black dots. They're going to be there and there. But what they do is they give more of a heads up. So if it starts off as a black squeeze, it can roll into a red squeeze. That gives you more time to prepare for what's going to happen. I'm like, awesome. And again, here we are. It's the black squeeze. And it rolls into the red squeeze. It gives us more time to prepare. But better yet, sometimes these black squeezes happen by themselves, and guess what? Those are good trades too. Okay, this one you can see had a little bit of a pop, maybe not as powerful as some of the red dot squeezes, but this one was amazing. That was like the biggest move on here was just the black dot squeeze. And then here, where there was no signal at all, boom. Okay, this little consolidation, we were able to catch the last piece of that. So I got super excited about this because basically it's given us now twice as many at bats and a heads up with the most powerful tool I've ever seen. I was super excited about this. The only pain in it was when I back tested this, I basically realized how much money I'd left on the table over the last 10 years by not having it. I'd go back and look at Amazon and see all the signals that the black squeeze was on there that I didn't catch. And like trading a 10 lot, it would have made like something like $2 million. I was over 10 years. I was just like, that's painful. It's okay though. It's a good problem. The other squeeze works great. It's just that this one was giving me twice as many at bats. And I was just like, wow, that'd have been amazing had I discovered that 10 years ago. But now we have it, so which is great. Okay, so we kept playing around with this, and then I wanted to play around with really tightening the parameters, okay? So we got the black dots are a little looser, so they can give us a heads up as to the red squeeze, and sometimes they'll only be the only squeeze that happens. But what happens if we tightened it up a little bit as well? And this became the orange dot squeeze. And so the orange dot squeeze here basically is the tightest of the parameters. So it'll start off with a black, roll into red, and if it's building up a lot of energy, it'll go orange. And what that simply means is that the compression, if you think of the compression as like this on the black dot, and then it's a little tighter on the red dot. On the orange dot, wow, it's super, super, super tight compression. And so by the time that pops, you're going to get a really, really, really big move. Okay, so that's exciting. So all of a sudden it's like, oh my gosh, this is great. So the Squeeze Pro now, so you'll see it something like this. So here's red dots. That's the one we've been talking about. And then here's, the black dots. They started off, two bars earlier than the red. But man, there's that one dot orange, and that's telling us that the compression is so tight, the odds here of actually even a bigger move than normal has actually increased. So yeah, we know that the red dots are going to give us a big move. We know that the black dots are going to give us a heads up and also a decent move on their own. But if there's an orange dot thrown in the mix, we're actually looking at the odds of an even bigger than normal big mover there. So that's what's so cool about that. So here's now I've been talking a lot about daily charts and stuff like that. So here's a daily chart. One of my favorite trades is like if you get a daily chart, and it could have a squeeze in it as well. But drill down to a 30-minute. I mean, look at this. There's a squeeze here, pop. Here's a squeeze here, pop. Another squeeze, right? And this squeeze is happening while a daily squeeze is happening. That's like 2 for the price of 1. You're not only getting power release on the 30-minute chart, but you're about to get power release on the daily chart. And so when those two fire off together, think of it as like a firecracker and a bomb going off together, and you can turn it into these fantastic, fantastic moves. And this was a day trade, and we did this one, in one day, turned into a $500,000 trade, like in 4 hours. I love that kind of stuff. Now, in a stock like that, I might wait a month for that opportunity, but the point is when it happens, I notice it and pounce on it. I would rather do nothing all month except wait for an opportunity like that when I'm fresh, I'm rested. I haven't had the crap beat out of me by the markets because I'm over trading and I'm emotional or anything like that. You don't need a lot of good trades like that to have amazing returns. And you can do these in small accounts too. I mean, this is obviously in my bigger account. And then in a small account, it's like, oh, I'm going to do a put credit spread. Okay. Hey, it was good for almost $1,000. In a $10,000 account. That's a 10% return in 2 days, annualized. That's off the chart. So it's okay if you don't have a big account. You can do small account trades on this. All right, so how do these compare? So the free squeeze is here, and then our pro squeeze is down here. So the free squeeze, here's the red dots, amazing trade. Now, if you had the pro squeeze on this one, what's nice about this is, first of all, you get the heads up, right? The red squeeze fires, but look at this. The black squeeze, after the red squeeze fires, the black squeeze fires too. So you get a little extra juice there, and you get to see it, okay? It's like, before it's like, oh, we've already been in this trade for like 5 bars. Maybe we should get out. No, the black one just fired. So now you got another 5 bars or so after that, okay? And in this particular case, there was no signal, okay? But the black squeeze caught it, nailed it. Right? That was a trade I wouldn't have taken before. Same thing here, black squeeze, right? No regular squeeze. Okay, right here there was a 1 dot red squeeze, and the 1 dot red squeeze is, while good. So one thing you would think is like, okay, is a 20 dot squeeze more powerful than a 1 dot squeeze? Believe it or not really. But I have found that about a 5 to 8 dot squeeze is the best, because that means that the stock is only pausing for a little bit, it's building up energy, and it's ready to go. The problem with the 1 dot squeeze, it's just you don't have time to react to it. It's like you might, you're going through the charts and you just didn't see it that day. And then 20 dots, it can be a pain. When it fires, it's not any better than a 5 dot squeeze. It just, you just got to be a little bit more patient. So now all of a sudden with the Squeeze Pro, it's given me a much better read of the markets. I've got twice as much data, twice as many at bats, and not only am I able to read the free squeeze better, I've got more at bats that I would have missed on before, which is great. So, again, how I use the Squeeze Pro is like, okay, here's the red dots, right? Well, the black dot showed up first. So I got a heads up, like, okay, this is, something's fixing to go down here. Same thing here, a little bit of a heads up. Here, a nice heads up. Again, nice heads up. And then sometimes it's the only signal that's going to take place, right? So if we're looking at this to the downside, because remember, this happens to the downside too, but the free squeeze really didn't capture this. The 1 dot squeeze happened here. The black dots, they started forming here while the stock was in consolidation, right? The momentum's below 0. Guess what? In that situation, it's a short. Boom. Here, there was a great move to the upside. No regular squeeze, no free squeeze, but we did get a little bit of a heads up that we had something here. And then here we got the orange dots giving us a signal like, hey, something big is about to happen. And certainly something big did happen. So it's really, 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 really amazing. And I know we talk a lot about the long side because, of course, the market has been trending higher. It doesn't happen all the time, but I love this for short trades too. This was Netflix. We had a beautiful squeeze here on the 195-minute chart, which is like a 2-hour chart, a little bit bigger than that. Daily squeeze, a beautiful, beautiful 39-minute squeeze. And, this is good for a short-term trade, $250,000. On the downside, just trying to catch a quick move in Netflix. Because we all know the markets don't go, they take the stairs up and the elevator down. So yeah, the market might go up and trend up for 2 months and then have a 3-day violent pullback. But in that 3-day violent pullback, as long as you have signals that can catch it and you understand how to read the signals, oftentimes you can make more money on that 3-day pullback than you did on that 3-month uptrend. That's how fast the markets go down. And so I'm always on the lookout for potential short side setups. Okay. So just to recap here, orange, red, or black dots simply means that the squeeze is forming and energy is building up. Okay. Black means that there's some moderate energy building up. Red means there's some decent energy building up. And then orange means, wow, there's a lot of energy building up. Okay. But it's all energy. It's all building up. They're all tradable. And then on the histogram, which we've talked a little bit about, but the histogram is either above or below 0. Okay, so here's the 0 line, and if it's below 0 and it's red, it means that momentum is below 0 and falling. If it's yellow, it means that it's below 0 and accelerating up. So believe it or not, that's bullish. If it's above 0 and dark blue, it just means that it's falling, and if it's light blue, it's accelerating. Okay, so again, we'll look at a chart on that. So here you can see light blue accelerating, dark blue above 0 decelerating. okay? Red below 0 accelerating to the downside, and then yellow essentially means that it's about to turn and start heading higher again. So all those are solid. Okay, so this is great, and as I was playing around with this, and I'm not a programmer, I just have ideas, and then Eric, who's awesome programmer, I'll bounce the ideas off of him and just simply ask him, is this possible to do? So, and Eric's a good sport about this because a lot of times I get really excited. I'm like, can we do all these different things? And he's like, yes, let me take a look. I was like, awesome. So the first thing I wanted, because a lot of times people would ask like, okay, how do I know if I need to get in long or short? So I was like, okay, look, if you could create a tool where that after 5 dots, if momentum's above 0, give me some buy signals on the chart, or if momentum's below 0, give me some sell signals, and that'll help me time the trade. And so these are called the squeeze signals, and they work great. And so in this case, here is the squeeze. Again, you want to look at, especially the red arrows. Remember, the black ones can be a little early, but it's like, okay, that was going higher, but boom, you can see that we're decelerating here, and bam. And then here we got the squeeze, and okay, it's a buy signal, it's a buy signal. I like to see, what I simply call concurrent buy signals, meaning that both arrows are like that. So same thing here. You can see like, okay, here's the squeeze. Nice. Even though we got some sell signals, and you can see, of course, that turned into a huge signal. Here's the squeeze. There's the buy signal. Here's the squeeze. There's the buy signal. Here's the squeeze. There's the buy signal. So what I find is that that's helpful is that for people who are like, look, I don't want to think too much. If there's a squeeze, I want to know whether to go long or short, and basically that's what that does. So that's a great addition to that. So as I was looking at that, I started thinking about, okay, I'd like some more improvements. And he's like, okay. So I gave him a call. I told him what I wanted. He's like, that might be too much, but let me give it a shot. And I'm like, let's just take a look and see. So there's these bars called early in and out bars, right? And I wanted to improve these. And I like to let's just look at the charts on this. So the early in and out bars, they do 2 main things, okay? So the early in part is basically saying, hey, there's a squeeze, and I want to know if it's about to fire. Like, we're 5 dots in. Is this about to fire, or is this going to be like a 20-dot squeeze? So the early indication, when you see the green dots here, that means that the squeeze is about to fire, meaning that we're about to get a green dot. What I love about this is that this is saying, like, hey, the train is about to leave the building. So if you're not on it, you're going to miss it. So I love this because sometimes you're watching, it's like, okay, I'm just going to keep watching. But when you see this, it's telling you get in because it's about to go. So that's the first part of that. And there's a second part of this that we'll get to in a moment. The second part of that is, though, how you manage the trade. Well, let's cover it real quick, and we'll come to another slide that talks about it. So the first part is early in, but the next part is early out, okay? And the early out just means that you'll notice here that if you see that the momentum here, well, there's a better slide that'll show it, but you can see here that the momentum is going up on the histogram, and then it turns darker blue, okay? So the early in and out bars, basically, the bars will turn before the momentum, and that allows you to get out sooner, all right? I've got some specific examples of that. So that was the first part. The next part is statistically, okay, and I know some people really like to dive into statistics as I do. And I just want to know, like, I want to be able to look at a chart and say, like, how well does the squeeze work on this stock, on this time frame? And I want the specifics. I don't want to eyeball it. And Eric's like, got it. So what the statistics tool does is literally say, like, okay, here's Amazon, and I'm going to go back and look at 1 year. So whatever data you pull up, the stats will also look at it and tell you how the squeeze is done. okay? And what, in this case, it was the red dot squeeze. It'll tell you if it's a red dot squeeze or a black dot squeeze or an orange dot squeeze. And it'll tell you that the average number of dots were 7, and that 7 of those, there was 9 squeezes. The average number of dots was 7. 7 of those fired long, 2 fired short, okay? The average post-squeeze run was 6 bars, with the longest being 9. And most important, the average move was 5% or $167, and then that was the biggest move. So now I've got some hard data, right? I can say, wow, there were 9 squeezes, 7 of them were long. The average post-squeeze move is 5%. I don't know about you, but you guys think you can make money trading options on a 5% move in Amazon, which is $167, right? Exactly. I mean, that data is incredibly useful for planning. So you can also do it, of course, on the indexes. So it's like, okay, great. On the daily chart, over the last 20 years, there have been 122 squeezes, 71 of them fired long, 51 of them fired short, okay? And then the average move over the course of 20 years has been $4.64 or 1.6%. That is some data that you can make some money with, right? That's how you plan. That's not eyeballing it. That's not like, oh my God, I wonder what's going to happen. That is data, okay? That's what I love that stuff. Okay, so then if we go back and we look at these bars, again, the early in and out, you can see again, squeeze. We got 3 arrows, one that's representing the black dots, one that's representing a buy signal on the red dots, and then another one that's representing a buy signal on orange dots. In my experience, when you get all 3 going, you're typically going to get a nice pop. And then here, when it turns green, remember the squeeze is about to fire. And then here, okay, sell signal on the black dot, sell signal on the red dot, sell signal on the orange dot, and if you're not in, you better get in. Okay, when it turns green, it's about to go. Boom. Right? So it's a beautiful combination there. And then, of course, you could go back and look at the stat tool on the S&P futures and say, gosh, how often does this work? What are the average moves? So the other part of this, because we've talked about getting into trades, and really where you make money trading is on the exits. Okay, you make money getting out of the trades. So what I used to do the old way is that, if the squeeze fired long, and remember when it's, first you're going to get the light blue histogram, and then when it rolled over and turned dark blue for 2 bars, that's when I would get out, because that's basically like, okay, it's over. And there's different ways to get out. You can use Fibonacci extensions, 821 EMA cross, but generally I like to kind of get out as the move is petering out. Sometimes the 821 EMA cross can be pretty delayed, right? While I'm a huge fan of extensions, the 1272 extension, if you're familiar with Fibonacci extensions, those are amazing, but sometimes the stock's going to blow right through it. And it's like, oh my God, I left all this money on the table. If I had done that with Tesla, I would have left so much money on the table, right? But sometimes the 1272 is perfect. So what do we do with this? So here's why the second part of the early in and out that I like is that it helps get you out on time. So here, again, perfect short signal, sell signal, squeeze. We're short the S&Ps. We're cruising along. This thing's down 70 points, right? If it's down 70 points, you don't want to give back a lot. So at point number 1 is when I got out. Now, you can see here that the histogram is still red, oh, it's still going down, right? But notice here that, we're actually turning. And by the time, if I would have followed my old rules, meaning that, okay, when I get a change in color of the histogram after 2 bars, I get out. Basically, we went, that's about 20 points. That's about 20 S&P points. So with the early in and out tool, that saved me $1,000 a contract by getting out at the right time. Okay. No, I'm not going to get out at the dead lows, but I'm also not going to hold out for, a move all the way back, to where I got in. And then here's a long signal, right? And we're in. At point number 1, the bars change colors. And then at point number 2 is where I would have gotten out the old way. Okay. Basically, I would have given up most of my profit in that situation because it came down pretty hard. But the early in and out tool is saying, hey, red alert, this thing has lost its mojo. And so I found this to be one of the best exit timing tools I've ever seen, because you're getting out at the right time. Okay, again, sometimes maybe the 1272 extension is the right time, right? But sometimes it's going to blow right through it. The point is, you never know. You want to get out at the right time. You want to get out when the momentum is leaving the market, and we don't know exactly when that's going to be. Getting in is easier. Getting out is harder. This is the best tool I've found to time getting out gracefully with the maximum amount of profit that the market is willing to give you. You're not getting out too early. You're not getting out too late. And that's why I like it so much. Just another example here. Using this tool, I get out here near the top. The old way, I would have gotten out here. Okay? And on this short, getting out here, old way, I would have gotten out here. Now, granted, this is about the same, but this is a lot of pain and suffering to hold on to for a week and a half, right? A week and a half. You want to get out and move on to the next opportunity. So long story short on this is that this, with the pro system, where we've got more signals, okay, we've got more squeeze signals, so we've got more at-bats, we've got signals that help us to clarify whether we should be long or short, and we've got early in and early out warning signals. You have a complete trading system. You have a complete trading package. And just, a couple more examples here. We got the squeeze, boom. We got the squeeze, boom. And, if you had gotten out at the 1272 extension here, you would have left money on the table. So you can time it like, okay, how are we acting here? How are we acting here? And then the next squeeze sets up. And, again, it's just a complete trading system. On Shopify, and again, if you trade stock, that's fine. Buy the stock. Whatever the signal is, if it's a long signal, typically I'm either going to buy the stock, okay, or I'm going to buy calls. I'm obviously a huge fan of buying calls. Typically, if I'm buying calls, I'm just going to go in the money. Or slightly at the money. If I'm going to go out the money, I'm typically going to do a call credit spread. And I'm a big fan of put credit spreads. Put credit spread, you're not going to get that huge bang for your buck, but it's a nice way to kind of offset any premium decay. So it's a good combination. So combination of long stock, put credit spreads, long calls for long plays, and obviously the opposite there. And again, we talked a lot about long plays. I love short setups. So boom, nice short setup here. And this thing just absolutely rips it to the downside, okay? So the point is that with a squeeze, the downside moves aren't really a surprise. A lot of times, downside moves take people off guard. It's like, oh my God, where'd that come from? If you had a system, if you had a signal, the signal would have told you that was coming, right? Again, just a couple of other examples. Just, I want to buy stock. Okay, great. You buy the stock. This is a 5-minute chart. And, it's a lot of money in a short amount of time. Shopify, a lot of money in a short amount of time. And a lot of times people ask, can you do this on the indexes? Yeah, you can do it on the Qs. You can do it on futures. In this case, I bought 2,000 shares of the Qs, but as you guys know, you could have bought 20 in the money call options, taken up a lot less capital, and made about the same amount of money. So that's why I'm a huge fan of options. This is one on Amazon. Same thing here, where you've got a squeeze, looks great, and this thing just rockets higher and turns into a $400,000 trade. And then, of course, Google. This was just a pretty amazing trade here. And chop. It's building up energy. And then look at what happens when it releases that energy. Okay, it was pretty crazy. On this particular trade, this was my biggest trade ever. I made $5 million on this trade over 2 accounts. So in Tastyworks, it was about $800,000 that I made on the Google trade. And then in my Thinkorswim account, it was a little over $4 million that I made. And so net, just a hair over $5 million on one trade. That's what I'm talking about. You can sit there and chip away and over trade and make a little bit here and there, and that can be emotionally exhausting and frustrating. Or be patient, understand what a great setup looks like, and then learn to identify that setup. And when I saw this in Google, I was just like, this is going to be a big trade. I didn't know exactly when it was gonna go, but I was super confident sitting through it, losing money while waiting for it to go. And, the patience obviously paid off. But that's how much confidence I have in the signal. If I was doing that trade and I wasn't using a system, right, I would have gotten shaken out of that. But when you've got a system that it's proven itself over and over again and has the statistics to back it up, your confidence level increases. And when your confidence level increases, you're able to hold on to the trade longer, okay? You're able to be pickier, and you're able to just simply make a living trading, which is tough for a lot of people. A lot of people, just the psychology gets in the way. And I found at the end of the day, we want to save ourselves from ourselves. So I learned this the hard way. At first, you're trading, you're like, oh, I got to make some money. But you really got to get your head dialed on correctly, or it's going to screw with you. And what I found is that if you've got the right setup, all you got to do is release your anxieties and follow the pretty colors. Instead of coming into the market with an opinion, oh, this is going to happen or this is going to happen because I saw this news thing. What's the setup? Is there a squeeze? If there's not a squeeze, why are you looking at it? Who cares? Look for the squeeze. Okay, are the moving averages stacked, right? How long has it been a squeeze? Do I have buy arrows? What are the early in and out indicators telling me? What do the statistics say is the average length of a move that this is going to have? Okay, that's data that can make you a lot of money. Okay, versus like, oh my God, I saw this, on Wall Street Bets. Maybe that'll work and maybe it won't. But this is stuff that works consistently, without all the hype and all that kind of stuff. So save yourself from yourself. So the key to combat anxiety and the psychology that, really can implode a lot of traders' accounts is to have a specific system or strategy with clearly defined entry points, but more importantly, clearly defined exit points. Entries are a dime a dozen, as the saying goes, but exits are where you make your money. These entries have been honed in over time, where they're the highest probability entries I've found. Once you're in the trade, though, you still got to learn how to manage it. You don't want to freak out. You don't want to get out too soon. Let the system tell you. Take your emotions out of it. Go for a walk. Drink some water, right? Put the mouse down. And, I always joke, it's like, a lot of people will ask me like, oh, God, how do I get rid of this anxiety? You don't. You just learn to live with it. You learn to be comfortable being uncomfortable. Don't let your emotions flow down your mouse arm and take action. Okay, your emotions are your enemy in this situation. You can observe them, learn to meditate, let them go. Follow the system. And once you start following the system, do it small at first, one lats. And once you start to follow the system and have it override your emotions, you're going to be like, wow, this is so much easier. And you start to trust it. And then you start to ignore your emotions. Your emotions are basically your ego screaming at you, wah, 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 wah. That's not going to help. It's not going to help. I'm a huge fan of Mark Douglas. He's got a book called Trading in the Zone, which I highly recommend. I love this quote. It's very painful. Consistent losers do almost everything to avoid accepting the reality that no matter how good a trade looks, it could lose. This quote cuts deep, okay? Look, I've never put on a trade thinking it's going to lose. Every trade I put on, I think it's going to win, but not every trade works. So 75% success rate, that means 25% of the trades aren't going to work. What does that mean? That means you got to really dial in on your position sizing. That means that you don't bet the farm on every trade, because you could win 19 trades in a row and then lose it all on the 20th trade. There are times when I put on a trade, the setup's perfect, but the next day the stock is downgraded. The next day the FTC is investigating it. That's going to happen, right? It's a probabilities game. So this quote is gold. Understand that you can lose, and you take care of that by position sizing, okay? So, don't risk it all in the next trade, but if you're an aggressive trader, can you risk 5%? Yeah, you can. If you're a conservative trader, can you risk 1%? Yeah, you can. Don't bet it all. Don't do that. Don't be that guy or gal.